Good morning, good afternoon, and good evening, everyone, and welcome to our Fall M&A Bootcamp. My name is Colin Mahan, and I'm the Director of Programs at the Nasdaq Entrepreneurial Center. And for those of you who may not know, the Nasdaq Center is a nonprofit that's building a better path for entrepreneurs worldwide by improving inclusion, access, and knowledge in entrepreneurship. As you're going to see in the chat in just a moment, the Nasdaq Center provides programs, resources, and exceptional mentorship to entrepreneurs across all races, industries, and geographies. So check out those links and resources in the chat. We got a couple of housekeeping items before we get started. Firstly, let us know where you're dialing in from in the chat. Secondly, we're going to open up for live Q&A at the end of each panel, so please submit those questions for us and the Q&A function at the bottom of your screen throughout the presentations. We will try our best to get to them all. Now, none of what we do here at the center would be possible without all the amazing support from our sponsors, including Nasdaq, Lehigh University, BMO, Airbnb, KPMG, Wilson Sonsini, Woodruff Sawyer, Microsoft Entrepreneurship for Positive Impact, BPM, and HubSpot for Startups. We're humbled by their contributions and hope you're grateful too. Now, before we get started, I'm going to launch a few polls to take a step back and see how everyone in our audience is doing. Our first poll here is, how are you feeling about your business right now? Q3 came before I know it, and so here we are. Are you optimistic, in survival mode? Are you feeling a little anxiety? Let us know. We use these information to provide additional wellness and resources for the entrepreneurs, you, that we serve. All righty, I'm going to end this poll in just a moment. All righty, looks like optimism is in the lead, but there is a little bit of survival mode and anxiety out there and a tiny bit of fear. So hopefully our presentations today will help alleviate some of those sentiments. Now, the second poll I'm going to launch is just going to ask, what side of M&A are you looking to learn about today? Are you looking on the buy side, looking on the sell side? Let us know. This will help our panelists understand where you're coming from. All righty. Looks like it's a pretty even, almost even split. But we've got more on the sell side. So entrepreneurs here looking to learn what M&A looks like. All right, I'm going to end this poll, share those results. Looks like sell side is just above the buy side, but good mix. And we're going to be covering both. So good news for all. All righty. So I'm going to cover the agenda before we get started. So we're going to kick off the program with a market update, followed by a panel for those of you looking to learn more about the M&A strategy for early to mid-stage entrepreneurs. Then we're going to have a quick 10-minute break and transition into our second panel, where our panelists will share growth through acquisition, the buy-side overview. Please note the same Zoom link will be used for both sessions. So without any further delay, please join me in giving a warm welcome to our first presenter to share our M&A market update. Anthony Sassano is a Director of Mergers and Acquisitions at BMO Capital Markets. Anthony, welcome, and over to you.
Thank you, Colin. I appreciate the intro. We've got some slides we're going to share here that Ann will put up on the screen. I want to give you a brief introduction, but thank you to the Nasdaq Entrepreneurial Center for the opportunity to speak with you all this morning. As Colin said, I'm Anthony Sassano, the director in the Middle Market Mergers and Acquisitions Group at BMO, where I focus on technology and business services M&A. It's a quick background. I've spent 15 years in mergers and acquisitions, including a period of time on the buy side in the private equity world. I'm excited to be here today as I'll provide a brief overview of the U.S. M&A market with data that we've gathered from a few sources and some anecdotes of my experience and daily conversations we're having with founders, CEOs, and private equity venture capital firms around the industry. So let's get into it on the next page. Starting with a bit of history here. So following the 2008 housing crisis, M&A rose at a fairly steady rate through 2016, held relatively flat. There was a notable down year in 2017, but then was flat through 18 and 19. And then, as we all know, along came COVID. First half of 2020 saw M&A market pretty much shut down after the pandemic had spread, starting really March. But then the back half of 2020 was really a gangbusters year that ended up spilling into 2021. 2021 became so busy that everybody was trying to get to market, to the point of there were accounting firms that weren't able to take on new mandates. There were law firms that weren't able to take on new mandates. Investment banks were so busy that it was just a rush to get things to market in a timely fashion. So when you have, three outside providers saying that they're almost too busy, it becomes almost the breaking point of the M&A market. It's the only time in my career I've seen that. It was held together. Obviously, there was great performance. A lot of good deals got done, but also spilled over in 22. The end of 21 was also marked by, there was potential for capital gains law changes in 22. So there was a bit of front running the 22 market into 21, which is why I think there's such a huge peak in 21 and then 22 happened. Now, again, 2022 maintained a strong M&A market till early summer when the Fed started their 4 in a row 75 basis point hike, which, that put rates at a point, or currently puts rates at a point where they haven't been to since 2007. So while M&A markets have fallen from the 2021 record, the number of deals in 23 is expected to be strong. Volumes in terms of total dollars may be down, but deals are still getting done. There are a ton of corporates, strategic buyers with large piles of cash that are looking to put it to work, and private equity firms with reasonable structures and the ability to get debt financing are getting deals done as well. On the bottom part of the page for IPOs, up until recently, there's been a bit of a lackluster performance. The IPO market has come back a bit. There's been a few notable IPOs in the market over the past 8 weeks or so. So that will be a viable alternative to M&A going forward. But focus today is M&A, which we continue to expect to be strong through 2023 and really strong through 2024. And the next page, please. So looking at the U.S. M&A market by industry sectors, we see some interesting trends over the last 5 years. Energy materials seeing the largest declines in terms of proportion of total transactions. Technology in the last year has seen some notable declines, given that long-term cash flows are more of a focus now, and obviously requirements of cash flows and profitability is now more important than ever with the markets being where they are, especially treasury rates being so high. It's now not an issue of where do I put money to invest, it's where's the best opportunity to get my returns for myself and or my investors. Anna, next page, please. So if we look at some of these trends here, and I think this will be the money page for a lot of people, no pun intended, but where are multiples going, right? And this page is a bit eye-catching, so you got to caveat a couple of things. One is that some of the numbers are a bit skewed just due to publicly available data. But if you take a look at what's going on, you see a pretty steady, consistent increase over the past 3 years in most sectors. Bit subdued in 2023 due to rising rates. But deals are still getting done, and they're getting done at pretty strong multiples across all sectors. Now, again, there's some declines, technology, financial services, on the EV revenue standpoint, but we can be fairly confident that that's all coupled with the rising rates environment that we see ourselves in. So whether that changes going forward, we'll get to that in a minute, but we feel that it's pretty steady state for the time being, and we continue to see deals get done in these industries, albeit just with a little bit of consternation, maybe with paying the higher multiples that we saw, just a year ago. Anna, next page. Thank you. So when looking at M&A, it's always important to keep a number of things in mind. One of which is to understand the buyer's availability to capital and the cost of capital. So funding's become a little bit more scarce. Good thing is that global financing or fundraising for private equity firms had hit peaks in recent years. There's over $1 trillion of dry powder within the industry. So there's plenty of capital to do transactions, to affect transactions. People are being a little bit more, I don't know if cautious is the right word, but they're taking the time to do further diligence and be very succinct at all of their points nowadays. Cost of debt on the chart at the bottom being the key driver of that, right? We're seeing costs of debt that are significantly above where they've been for the past 10 years. There's a scarcity of some debt providing that has thawed a bit since the summer months, but through summer was a bit more challenging of a debt environment just to raise any debt for any sort of acquisition that was coming out. We expect that to thaw and continue to be more free flowing through the rest of the year and into 2024 as rates stabilize, as people become more used to this new environment and are able to, on the buyer side, both model out where returns will be based on these rates. And as a entrepreneur, owner, founder, business runner, to be able to effectively operate your business given this new environment and where your cost of debt is going to be. Next page, Anna, please. So things to consider for the rest of 2023. There's a number of aspects, obviously, to focus on with M&A. One is the Fed, as we've talked about a couple of times, is that we expect the Fed rather to continue to maintain elevated rates for a while. We expect core inflation to kind of remain where it is. There's obviously concerns around what happens with oil prices, with OPEC in the news lately, a couple of other different insourcing trends that may drive changes in CPI over the near term. But overall, we expect rates to remain relatively flat. Whether there's another hike through the remainder of the year or not remains to be seen. But we don't expect too many above the one if there is one. A focus on cash will continue to be the focus with Treasury yields at near two-decade highs. Near-term profits and ability of companies to generate cash becomes a point of focus, especially as the ability to pay down debt comes at a premium in this high interest rate environment. But overall, we remain optimistic. We believe that the economy is in for a soft landing. We believe that the middle market will continue to prosper, and our clients and ourselves are focused on growth and expect a very good 2024 in the M&A market. I'm hesitant to say it'll be 2021 levels. I almost hope it's not, because 2021 was so crazy. But return to normalcy, if there is one, but a optimistic outlook through the end of the year and into 2024. Thank you again for your time this morning, and back over to you, Colin.
Awesome, Anthony. Well, we love optimism in the morning or afternoon or evening, wherever you are. So appreciate you sharing those insights. Before we jump into our next session, I'm going to launch another poll just to learn more about what you are looking to learn about and in the next 3 months. How many of you are exploring M&A as an option? So are you fully looking into it? Not ready yet? Just here to learn more? Let us know with Anthony's optimistic market update. Hopefully many of you are here to learn more and exploring it with our experts. All righty. This will also help our panelists that we're going to be joined with in a second understand where you are in the process. All righty. Well, I'm going to end this poll. Share those results. Fully looking into it and here to learn more are in the top and just not ready yet. So hopefully our panelists will cover the whole gamut. So without any further delay, we've got our M&A strategy for early to mid-stage entrepreneurs panel. Please welcome our panel of experts. Our moderator, David York, is a global strategy partner at KPMG. We've got Caitlin Skopek, who's a corporate advisory director at BMO. We've got Todd Dorsey, Vice President, Private Equity and Venture Capital at Woodruff Sawyer. And we've got Jackie Hamilton, who's a partner at Sonsini. Welcome, team.
Morning, Colin. Morning, everyone.
Morning.
Good morning. Good to be here.
Morning.
Here we get going. So let me just do a quick kind of round of more formal introductions. Thanks for joining. I'm David York. I'm a M&A advisory partner for KPMG. I'm based in Silicon Valley, and I spend most of my time helping corporate clients with M&A activities. Todd?
Hey, everyone. I'm Todd Dorsey. I'm Vice President at Woodruff Sawyer, working remote in Kansas City. Our firm is based in San Francisco. I spent most of my time with private equity firms on the buy side, helping with due diligence, rep and warranty insurance, and target company insurance management. Good to see everyone today. Looking forward to the conversation.
Thanks, Todd. Caitlin?
Good morning, Caitlin Skopek. I'm a director at BMO in the corporate advisory division. I am based out of California. I work with middle market companies who are trying to decide what's next for their business, whether it be growth or liquidity. And so buy side M&A and sell side M&A.
Perfect. Thank you very much. And Jackie.
Hey, great to meet everybody. I'm Jackie Hamilton. I am an M&A partner at Wilson Sonsini, based out of our New York office. Little bit of buy side, little bit of sell side, both, public and private M&A, but M&A all day, every day. It's kind of the way I like to say it. Back to you, David.
Perfect. So Jackie, let's come to you with the first question. So we saw a very positive outlook, I thought, from Anthony just now. I guess, how have you seen the sell side evolve through kind of calendar 23? And what do you think that means for startups that are looking to get acquired in the next quarter or so?
Yeah, no, I think I'm quite aligned with Anthony. So, we certainly have seen an uptick, particularly in smaller deals. I'll say that don't implicate regulatory scrutiny. So your mega mergers are still in this space where, the FTC DOJ is looking very closely, and that's still impacting things a lot. But I think, in the deals that are below, particularly below $100 million, there's a lot of opportunity. Certainly, I don't think anyone is forecasting the 2021 deal numbers that you saw on Anthony's slides. But I think the M&A market is certainly active. There's lots of buyers out there, as he mentioned, with money to deploy. I think deal valuations in the tech space are still somewhat lower. But I think for companies, in particular, newer companies or companies that didn't raise a significant amount of money in that heavy valuation space in 2020, 2021, there's huge opportunities, right? So one thing I'll talk about later is a little bit about waterfalls, but I think it's a huge opportunity for several different types of companies out there. So
perfect. Caitlin, anything to add to Jackie?
No, I agree, and pretty much Anthony laid it out from what BMO's seeing. I would just also say, to echo the strategic side, there is such a cash pile in some of our corporate strategics who are looking to make an acquisition. So we're seeing a lot of that.
Perfect. Thank you very much. And Todd?
Yeah, other than the fact that we're seeing some more divestitures and a little bit of a slower but uptick now lately in the private equity space, now the interest rates are a little bit more stable. We do a lot of IPO business at Woodruff Sawyer as well. And so the IPO book of business has been quite a bit slower, as everyone on the call knows. We were able to get out Accelerant and Instacart, a couple of big names out there not too long ago, which were exciting. But certainly see alignment with what Anthony said. And I think that 2024 is going to be an exciting time for all of us, and hopefully Q4 of this year as well.
And do you think obviously we've seen a little bit of high profile IPO activity in the last month or so. Do you think that will continue into 24 too?
I do. I think that there's those that have gone out and kind of paved the way. And I think others are going to gain a little more confidence and security in the fact that others have been successful, and some will try and it won't work out, but many will, I think, follow in the footsteps. And I think it's going to be a bigger year this year. Certainly do that. Hope so.
Fingers crossed. Thank you. Jackie, what do you think about the main legal points that a startup and its board should consider when they're thinking about, determining the right time for a potential exit or an event?
Yeah, so I think one point to start off with, and this sounds probably pretty obvious, but just as a first step, I think it's a good idea to think about why you're selling. Because I think it's going to inform the rest of the process, right? So on one hand, do you think you're going to sell? Are you thinking about selling because the valuation that somebody has offered you is really high and this feels like a great opportunity? Which, again, even though we're not seeing the valuations of 2020, 2021, still some really high valuations out there. Or are you looking to sell because you need to do so, because you need cash, you need capital, and it's really hard right now to raise additional capital for whatever reason, right? So I think that those are really key process points to think about, because they're going to inform how you think about most of the rest of the process. Two things on the legal side that I talk to founders about all the time are, and I mentioned this earlier, about expectations around valuations and how that's going to flow through your waterfall, right? So thinking about whether or not that purchase price, once you deduct expenses and things like that, is it going to clear your full liquidation preference? And if it's not, what does that mean for getting stockholder approval? I know that these sort of seem more in the weeds, but I will say this is one of the big deal consideration points that you see in sort of a market that, maybe you had a very high valuation and you raised some money and now you're not going to get that money back. So these are things that I see stop deals sometimes. And then another thing I think to just always be aware of, and there's never a bad time to start this process, but just making sure that you're cleaning up some of the potential diligence faults. So capitalization, undocumented agreements. I think those are things that you need to, probably before you even start thinking about selling, you should be thinking about those. But if there's anything that could be a skeleton, you want to start thinking about that. You want to make sure your board's aware, because that potentially, has a very strong impact on the valuation number. So.
Got it. Thank you. Caitlin, what things do startups need to focus on, you think, when it comes to diligence, and what can they get ahead of, right, even in advance of potential conversations with interested parties?
Yeah, it's a great question. And I'm going to echo a little bit of what Jackie said in getting ahead of it, really starting to get things cleaned up. You want to tier up your advisors. And I always think about it as not just because we're all advisors here, but you should have a tier up of one tier ahead of where you are today, where you're going. So you should think about, if you're a small startup, you may not need a top 4 in every single category, but if you're working with a really local CPA, for example, you should probably start thinking about a CPA who takes companies through transactions and knows the diligence process. And same thing with all your other advisors. I'd also say you want to really start to think about having your personal and your corporate advisors be separate advisors. And yes, they can coordinate, but there's a point where it really needs to start to split, and you have to start thinking about cleaning up your balance sheet for many reasons, which we can get into. And then the other thing that I think is a great process to get you started in the due diligence world is establishing a credit relationship. And even if you're not credit worthy, even if it's just as much as getting a cash secured line or whatever it might be, or a real credit relationship, it's a really good due diligence process to start getting organized, because it's a capital provider putting you through, the ringer on looking at your financials, understanding your financials, looking at your corporate structure, understanding your legal structure, all of the things that Jackie just laid out. It's a good process. It's free. You're not paying the bank to put you through this process, but it's good to understand how a capital provider is looking at your business today and where there's areas of improvement for 3 years before you do a transaction. So I say those are 2 things that we really like to see.
And what's the kind of timeline that you typically advise your clients to be working to? So is it, what level of preparedness do they need at what particular point in the process?
It's a good question. I think it's a little bit different for lots of different types of businesses, but I say 3 years before a transaction. Most of the direction, the strategic plan, the advisors starting to pull together, and then at least 2 years before the transaction, you have your plan in place. That's ideal. Often it's a year out, we'll be honest, and sometimes less. But especially if it's a sell side transaction, you really need to have a full game plan and strategy in place. I'd be curious, David, if you have other details that you guys advise on that.
Yeah, I mean, so obviously the more time you can get, the better, right? Is my view. I think as we spoke about through 21, a lot of assets came to market really, really, really quickly, and I think it also depends on the nature of the market, right? If it's a really frothy market, perhaps the level of preparedness is not as extensive as you would need in a kind of down market like today, right? Where providers, potential buyers are really going to take their time to do their diligence, and obviously they're going to ask lots of questions. They're going to ask for lots of artifacts, and as we all know, right, it can be all consuming for management to go through that process. And obviously, the more of that you've got done in advance, right, the less of that is then a scramble once you're actually in diligence itself. So, I agree. I think being thoughtful and being prepared and taking time and effort upfront can save you a lot of kind of management time in the back end for sure. Todd, we always have this question every year about reps and warranties insurance, how kind of beneficial it is, what's the right time to think about it. Maybe just for the audience here, you could start off with a kind of simple 30-second, idiot's guide to what it is, and then, why you need it, and then what the right time is to kind of get it in place.
Yeah, sure, David. So rep and warranty insurance is essentially a breach of contract coverage. It is designed to enhance or replace indemnification given by the seller to the buyer. In short, once the ink is dried on the deal, rep and warranty covers some of the unforeseen costs caused by any breaches of the seller's representations whether it involves issues with customer contracts, employment agreements, or IP. So before the advent of RWI, as we like to call it, rep and warranty insurance, another name for it. So the uncertainty and the cash needed to account for it was handled by an escrow account. And the seller would typically leave about 10% of the sale cash with the buyer for a certain amount of time in case of a breach. With the use of rep and warranty insurance, it allows for a greater reduced escrow or no escrow at all, allowing the seller to walk away with most or all of the money up front and the buyer to get as much protection as possible and without forcing the seller to provide all that cash to back it. So to your question, this is one of the key reasons it's beneficial to the seller. As far as timelines, if you're thinking about it in advance of a purchase, that's in advance of a sale or purchase, depending on the situation that you're in, that's a good time to be thinking about it. You're going to want to, and I really do agree with Caitlin from BMO on this, you're going to want to up-level your advisor in advance of an M&A transaction. Someone that understands rep and warranty insurance, somebody that understands insurance due diligence, and somebody that can help guide you through the nuances, because it's not something you want to learn on the fly. You want to have an advisor on your side that's very helpful in pointing out what every piece of the puzzle means for you post-close and what everything is going to end up being for the transaction. So I think that helps a lot.
Are there specific use cases where you see, an increased need for reps and warranties insurance? Are there specific, types of events that are, hey, we should, you should definitely look at it in this instance, but not this? How do you think about those use cases?
Yeah, it's a good question. It's become so standard in most transactions. And so 75% of private equity transactions and 64% of the time it's used by larger strategic acquirers, and it's used for a reason. One of the reasons, and you ask a good question, possibly even more important than protecting everybody after a deal closes, is that the rep and warranty policy can help get the deal closed in the first place. Negotiating the reps and the warranties and associated indemnifications in an agreement is one of the most time-consuming and contentious parts of any deal. And so if you have insurance in place, the seller feels more comfortable granting the reps that the buyer wants, so the process is quicker and can actually get done. The other thing that's helpful, the diligence requirements in putting the policy together also provide a second set of eyes to make it more likely that anything that should be found is found before closing.
Got it. Thank you, Todd. That's helpful. Jackie, coming back to you, from a legal perspective, I guess, have you seen more deals being stalled in recent times because of the slowdown in market? And when you do see deals being stalled, why are they being stalled? And do you have any advice for founders, to kind of prevent that? Is there steps they can take in advance to kind of prevent that issue?
Yeah, no, it's a great question. And obviously, I think top of mind for folks, right? You want that, we talk about like closing certainty. So you want to talk about deal certainty. It's obviously you don't want the deal to fall apart. So I think, I'll start with the answer is yes. Certainly we see deals get stalled. So I think both Todd and Caitlin and, I think you've all kind of made this point as well, David, that in a market where people are more likely to do a bunch of diligence, they're more likely to find problems, right? And so that, yes, deals will become more stalled. I would say the things that happen that really stall deals, I was just thinking about deals that I've probably seen, 10 deals die this year. I think diligence issues are huge. So even the best companies with the best valuations, they start to look not as great to buyers if they're unorganized. So even if nothing is particularly wrong, they're unorganized and a buyer just frankly finds it difficult to conduct diligence, right? Just because it's slow, or they don't know where all their contracts are, or things aren't signed, or maybe they are, but they're in various places. Even if nothing is technically wrong, it just makes that process harder, and time does kill deals. That is just sort of a truth. I would say key diligence areas, capitalization, cleaning that stuff up. That is stuff you can do in advance, particularly around options. So again, to Caitlin and Todd's point about leveling up your advisors, I think financial advisors, as well as legal advisors, right? So if you're using a really small firm and maybe they're not as skilled in M&A, thinking about, 12 to 24 months in advance, 24 months, probably that might be too much, but thinking about scaling up to somebody who does M&A, I think is useful, particularly around things like capitalization. Things internally, undocumented agreements, contract management, making sure you know where everything is. I think one of the better investments I've seen is, getting a data room, getting a good data room. Don't get like just a Google Drive because you can't search those as easily, but spending whatever it is, at Intralinks, and I'm not trying to give them like a shout out here, but a Merrill, any of the really solid data room providers, I think that can be very useful if you actually think you're going to be teeing up an M&A transaction. And then going through and figuring out what are your, problem areas that you think, we've chosen to not spend a bunch of money like trying to fully comply with GDPR, but having a good response to that and thinking about why you've been strategic, because chances are you've thought about these things, and understanding how to best present that. Other times we see deals fail, frankly, because buyers and sellers sign up term sheets and they don't negotiate. They say, okay, the price is X, but they don't negotiate, what it's going to look like. Is there going to be rep and warranty insurance? Todd will probably love this. I try to put it in every deal on the sell side because it stops you from having a 10% or 20% more escrow, holdback, et cetera. It makes indemnification process much easier, but people often think, oh, I don't even need a lawyer or I don't need any kind of advisor when I'm looking at a term sheet, and they sign it and then they say, oh, hey, Jackie, guess what? I signed an LOI. And they say, oh, that's awesome. I wish that you would have negotiated, because the most leverage you have on the sell side is going to be before you sign that LOI, before you enter into an exclusivity period. So I'll wrap this up with, I think that, best advice here is two things, right? One, think about getting organized both internally with contracts and capitalization things and any sort of problem areas, and leveling up your advisors. Yeah, I'd say, roughly 12 to 24 months in advance. Again, if you think about an IPO, that's kind of the timeline. People don't give M&A that kind of credence, but I think you really do need that timeline if you're going to do it perfectly. And then I would say, again, consider negotiating more than just price at the LOI stage. So be ready that someone's going to stick a number in front of you. It's going to look great. You want to sign immediately. Call your advisor, call your lawyer and say, hey, I think that, maybe you remember that Jackie said on this Nasdaq panel that, hey, you should negotiate something else. So.
Thank you. And before we move on from this question, I guess, Caitlin, from your seat, have you seen any kind of increase in deals not getting done? And why is that from your perspective?
Yes, I think that we've kind of talked about it. There's a lot of stalled deals. And so I've seen less dead deals and more stalled deals. Let's see another quarter. Let's just get through this piece of the diligence, et cetera. So especially from the strategic buyer side, which we advise quite a bit on, is, hey, we like this, we're just not quite there. And then to Anthony's earlier point, a lot of folks are still figuring out their capital plan for 2024. And so really thinking about where are rates, what can we, afford here, and doing a little bit more due diligence on that side, and then using that to get to your valuation. So there have been a lot of strategics, especially, that have said, hey, we like this business, we want it, it's probably going to be next year. And so that's the stalled piece that I'm seeing the most versus just truly dead in the water. And do
they do, sorry, just to come in, do they typically come back, and do they come back at typically a lower price point? How have you seen that?
I've seen a mix. I've seen different structures. So a lot of, hey, actually, maybe we're open to doing something with a little bit more of an earnout and a different cap structure in general. So there's been a lot of that conversation from a strategic standpoint. And what I would say to the sell side is be open, right? Be open to different ideas. I think that this isn't 2020, 2021, or the years before it. The markets have changed, the debt markets have changed significantly for you too. And so be open to looking at a different model. So that's been a big piece of, hey, let's come back to the table and think about a different structure here versus, where we started.
Okay. And what other advice do you have for startups who are looking to be more attractive, I guess, from the buy side community and for acquisitions?
Yeah, I hate to beat a dead horse, but cleaning up your balance sheets, and it's beyond just, I would say, even in your financials, cleaning up your financials, getting your personal expenses out of the financials, really starting to think about that. And then also being able to manipulate your financials and your data. So understanding your own business. Can you slice data? Can you say what your margins are by product? Can you really communicate quickly and organize, to Jackie's point, each part of your business. And if you can't, spending some more time upfront on that makes a huge difference in the process, and also the multiple, drives multiple up. And for a reason that a lot of people don't think about too, which from the strategic angle, if you're buying a company and you can use that company's cash flow and their assets as leverage, you can drive the multiple higher. You can afford to use more debt in your transaction than equity. And so banks are very much looking to help strategics grow accretively. That's a place that you just end up seeing multiples go higher if you can leverage the targets. And so that's a big thing that targets just don't really think about in the time, is like, hey, I don't necessarily need to get this piece cleaned up. My buyer will, but if the buyer can use, those financials clean from the start, it really, really makes a difference in multiple.
Got it. Thank you. Todd, I wonder if you could just talk to the group here a little bit about risks from the startup's perspective.
Yeah, of course. I mean, there's a myriad of things buyers are going to want to see during their forensic review of a seller's business. And believe it or not, insurance and what insurance policies and the structure of those policies is going to be one aspect of that review. And so essentially, they're going to want to gain confidence that the correct insurance is in place, because based on your operations, do you have the right insurance? And make it as simple as that. Do you have the right insurance to account for the different risks that are inherent in the operation of your business? Is another way of saying it. And there's situations where if the insurance is inadequate or deficient, or simply just doesn't cover the right things, it could be a big problem for a small company or a company that wants to sell. And I'll give an example. Cyber liability, cybersecurity, it's a hot topic, and it has been for multiple years with ransomwares on the rise. It's been a challenging thing to deal with as a business owner. But there's a lot of software and tech companies on the line today, I believe. If you're not thinking about cyber liability insurance correctly, and you do have a massive data breach, it could bankrupt the company. It sounds crazy to say, but I mean, it's a problem that can be avoided with the right insurance policy, but even more so, the right security posture of your firm. And so this is a crazy thing to think about, but post-close, with this infusion of new capital, it can create a big target on the recently acquired firm, because bad actors now know there's a lot of inflow of capital, and they can probably pay a ransomware, attack, they can ransomware claim, a ransomware event. So it's something that can be taken care of relatively easily by engaging with an insurance broker. This goes back to probably a trend that we'll talk about through the time, but up-leveling your advisors, like we talked about, 12, 18, even 24 months in advance of a sale process can be very helpful. And having your house in order can be very helpful. And one of the ways to do that is just to work with an insurance advisor that can get you set up so that your structure today is adequate. Many entrepreneurs have a great amount of risk taking embedded in who they are, which is one thing that I love and many of the people I work with love about entrepreneurs. But simultaneously, institutional capital may not necessarily be as comfortable with some of the risks that they've taken with foregoing the amount of insurance or insurance coverages altogether. So insurance is certainly a top of page issue. We just like to say it's a top of page 3, not 1 or 2.
Yeah, and I guess in that cyber example, I guess there's a bunch of preventative stuff, right, that the sell side can do too, right? And they can hire advisors, or they can, through the diligence process, I guess they can also, show some of the steps that they've taken preventatively. But I guess also having insurance against the, some event, etc., is helpful too. I guess, how do you think about that balance of, spending money up front, right, getting your house in order versus, insuring against the potential downside risk thereafter?
Yeah, I mean, it's a tough situation, especially if there's any capital constraints involved, because the amount of money that you could spend on improving your security posture is endless. And that's not necessarily always the right call. But if there's vulnerabilities, and if there's a business that really does rely heavily on the cloud, it can be something that's helpful to utilize. And there are a lot of outsourced providers. You don't have to have everything in-house, just like a lot of people use AWS and don't have their own servers. The same concept applies for a lot of these outsourced threat detection and mitigation and incident response companies that can help. Of course, insurance is just a backstop for that. And by the way, the insurance marketplace from a cybersecurity lens specifically has gotten so challenging in the last few years that if you don't have a number of security posture improvements made, you probably won't be able to get insurance. And so they do kind of come together. It is helpful to talk to an insurance advisor that's specifically good in that space, because they will have usually a Rolodex of people that are non-insurance people that are only cybersecurity posture professionals they trust and know, and can make things a little bit easier. And generally speaking, they have a little bit of a price reduction or favorable pricing for those providers too. It's a good question.
Got it. Thank you. Jackie, given the size of the audience here, is there one bit of advice that you regularly give to entrepreneurs around M&A that you can share with the group?
Yeah, I mean, I was thinking about this, and I think I kind of hit most of these before. Again, I really think that thinking about M&A not just as something that's reactive. So I think often people view IPOs as proactive, right? Because you've got to get audited financials. You have to do a bunch of things to lead up to that. Often people are getting, they're getting new board members. People view often, not always, but often M&A is reactive. You get a term sheet, someone comes to you. But if you think about it early and you think, look, I'm not going to do an IPO, but I do think that there's going to be an exit, particularly if you're a venture-backed company. That's probably the plan, is that there will be an exit at some point in the future. What are things that you can do? And so we've touched on them, so I won't belabor the point. But I think thinking about it like that to set yourself up for a successful exit process, and not just say, oh, I'm operating the company, I'm not thinking about an IPO. To leave yourself that proactive spot. And then again, I really think that even if you can't clean up diligence areas, or that you've made choices to not, again, like complying with the California Consumer Privacy Act, like that's just pretty much impossible for most smaller companies. Just maybe jot it down, remember what you're thinking about that, and so when the time comes that you remember, oh, actually we did think about that. It's not the first time I'm hearing about it.
Thank you. And then Caitlin, I guess similar question to you. So, given your experience on the buy side, are there things from a sell side that kind of translate across, or that people typically miss when they're going through, the setup for a sell side transaction?
Yeah, I probably, similar to Jackie, have hit this too hard, but I'm gonna just hit it one more time. I actually have a funny story. So we say a lot of times in early stage with middle market companies, as they start to think about what's next for their business, how often are you working in the business versus on the business? And when we start to talk about working on the business, I get really specific. I say, are you setting aside a day? How do you, look at your time on your calendar? Do you meet with your advisors regularly? What do you do? And one of the CEOs took this conversation. He was a founder, small, mid-sized business. And he invited all his advisors over to his house for dinner about 6 months before he was starting to think about, really starting a process. And he had all of us, and he said, he didn't even tell us all we were coming together as a group. He said, just bring a couple business cards though, and gave us that heads up and said, come on over for dinner. And in the dinner with, his CPA, his banker, his lawyers, and then some of his key employees who are also part of the business, he laid out, a lot of the things that are important to him about the next few years for the business, for both the employees and the advisors to hear at once. And I thought it was such an incredible night because everything started from a place where we were all on the same page. You didn't have advisors. Everybody has their own lane to give advice, and if sometimes it comes into other lanes, but you had everybody somewhat aligned. And I thought that was a really, really interesting approach for a founder to take. I now will say, hey, can we get together with all your other advisors and sit down, and then we can communicate as well and come up with ideas and different pieces of advice. So that was one thing that I thought was really cool in terms of trying to level up your advisors and then staying coordinated across that board.
Got it. Thank you. And Todd, assuming you weren't at the same dinner as Caitlin, I'll take that as a guess there. But do you have any other advice? What other things does sell side advice or sell side actions look? What do they typically miss in your experience?
Yeah, I think the insurance program, from the current state, does not typically look like the insurance program post close. And so the closer that you can get the insurance program that really a corporate acquirer would be comfortable with, confident in, now the better. And so working with somebody that has M&A experience in the insurance lens, they know what to look for. If you're a founder, owner, operator, it's going to be a little bit more challenging to predict what any acquirer would like to see from you. And these are not complicated or challenging changes to make many times, but just having them made in advance once diligence is done and having house in order, and some of the comments that Caitlin made earlier ring true. It's just being organized and prepared. You'll just show better and have everything ready to roll in such a way that your corporate acquirer will not be frustrated and or feeling like you're slow to give them everything that they're asking for, because it moves fast. And I think there's something to be said for being ready emotionally and mentally and physically for a transaction, because it's another full-time job on top of your existing job. So when we talk about working in the business versus on the business, like Caitlin mentioned, you certainly have to do a little bit of both during an M&A transaction.
Okay, and then just staying with you, Todd, if you look forward for the next kind of 6 to 12 months or so, what excites you, and what's your level of optimism around the kind of M&A market?
I'm very optimistic. I mean, our team specifically has seen an uptick after the summer. A lot of the folks we work with in private equity take a little bit of time off in the summer, and then they jam pack a lot in the back half of the year. And so we're starting to see a nice uptick with multiple deals going on, and I think that's going to extend into Q4. And what we talked about with Anthony earlier, I think 2024 is going to be a big year. I mean, the fact remains there's record levels of dry powder in companies that have a lot of cash on hand and are still looking to find deals. And many of those corporate acquirers and or private equity firms have been on the hunt for a little while. And so they may be just waiting for a little bit more from that founder, owner, potential seller, to see a little glimmer of another quarter of earnings and profitability, and then it's going to be there. And simultaneously, I think there's been sellers that are waiting to find the right buyer, what right partner. So I think it's going to be a great Q4 and 2024 as well.
And do you see like a two-speed market still between kind of private equity and corporates, or do you think that they're all operating at the same kind of speed now?
My experience is primarily on the private equity side, but I do have some colleagues who work on the other side. And in private equity, I think we're going to see it really ramp up. And I think there's still going to be, of course, others in the corporate side, but there's been some take privates we've worked on as well, and there's been some divestitures. But otherwise, I think the private equity sector that I focus on is going to be hot in 2024.
Perfect, thank you. And Jackie, what about you? What's your kind of outlook from a Wilson Sonsini perspective for the next 6 months or so?
Yeah, no, I mean, I think similar to Todd's point just now, I mean, I think I certainly remain optimistic and certainly still seeing that trend upwards. Again, I think capital markets have started to open, as others have mentioned, and there's been a few recent tech IPOs. There's non-tech IPOs as well in other spaces. So I think there's just cautious optimism, but I would just say getting more away from the cautious point now, given that the tech IPOs have gotten out there. So I think that's going to just mean more people in the market with money. So I think, as others have mentioned, there's already money that needs to be deployed. I think we're just going to keep getting more money. Again, I think we're going to start seeing or still see sort of add-on type or smaller deals rather than the giant mega mergers. I think that's still going to be an area of regulatory scrutiny. But yeah, so I think remaining optimistic is certainly the takeaway there.
Perfect. And Caitlin, maybe I won't come to you on this one. I know bankers are always super optimistic, so I assume that you would be super optimistic. But maybe before we transition to Q&A, do you have one piece of advice that you would give to the audience here?
Yes, and it's going to be similar to Jackie's, but maybe one step further. If you're talking about selling your business, she laid it out, know your why right up front. But I also think it's really important to know what's important to you in the transaction. So, as you start the process and you start to think about strategic versus a private equity buyer, what's important to you? What is your level of involvement and your key employees? What do they want to stay on? What does their lives look like? And really thinking about the equity and the structure and how you want your life to look over the next few years. That's a really, really important part of the process that you got to do up front and be able to really communicate. You are going to be working with advisors who are going to try to drive, they get paid on valuation. And so they are going to sit there and say, well, let's get you the max value here. And maybe that's not what's the most important for you. And so really understanding, hey, I want to stay on and I want this much equity and I want to be able to be a part of this. And I need this for my business to scale. So maybe this strategic buyer, maybe it's not the highest valuation, but they're going to be able to give me access to things that I just can't access. And being able to say that up front, and not get yourself pushed down a path too late and then have to bail at the end because you just didn't like the process. That's a really, really important thing. And we spend a lot of time, I'm outcome agnostic. So I don't care if you sell your business or if you keep your business and you buy a business. So we spend a lot of time getting to have that conversation of what's important and why. And I think it's a good way to start your process.
Thank you. That's really sound advice, I think. Todd, what about you? One key piece of advice you'd give to the crowd here?
I think I've mentioned it before, but I like what Caitlin said there. I think finding what your why is crucial. I think that's a component of every founder, owner, operator's mindset, but just to what extent. And I think if you really know what you want out of it, it will make the challenging but exciting process of M&A a little bit easier. And like I said a moment ago, I think you have to be ready mentally, emotionally, and physically for it. And any of the up-leveling advisors, which I know we've hit on a couple of times, but not just because we are those, but because I think it matters, because you will have people you will need to trust for different aspects of the deal that won't be common for you, will be a little foreign. And you need to have people that you do trust, that do understand that, and have worked in that space for years to guide you. And it'll just allow you to sleep at night and get through the process in such a way that you're feeling successful, not only with the outcome financially, but with just the process in general. Specifically, if you're going to continue on and work in the business after you've sold it, and there's potentially an earnout period or something like this.
Thank you. And then Jackie, finally to you. What's the one piece of advice that you would give to the crowd here?
Yeah, I mean, I think I'm just going to be repeating myself and both Caitlin and Todd here. So I'll keep it short. I think, again, being upfront with yourself, in addition to all the stuff you're doing for your business, if you are the person that's making that decision, if you are the founder or the main operator, the executive that's making this decision, I think understanding where you want to be and how you want the process to go. So do you want to stay, to Caitlin's point? Do you want to stick around? Is there going to be an earnout? How does that work? Thinking about all of those things and perhaps sort of summarizing that is to just be ready that it's not just a number. There's a whole lot more that goes into a deal. And so, I think that kind of sort of encapsulates what we said. Is there's just so much more. And so.
Thank you. And before I hand back to Colin to do the Q&A, maybe just one extra thing to add. So the thing I've spoken about on this panel a few times over the last few years is, don't underestimate the level of impact that M&A has on your business. It will be all consuming, depending on the size and scale of the operation that you have. And I think a lot of people, go down an M&A path and they don't realize, the level of diligence that will be required, the level of Q&A, just the level of time that it will soak up, and the level of distraction that folk will get from their normal business. It's really, really, really important. And I think, to Todd's point, surrounding yourself with a decent set of advisors, right, can at least help alleviate some of the burden there and give you the right counsel as you go. So, Colin, I'm coming back to you. I'd just like to thank the panelists, so Todd, Caitlin, and Jackie. Thank you very much for your insight this morning. Colin, over to you for Q&A.
Yep. Thank you, David. And Todd, Jackie, Caitlin, love all the advice you've given during this panel. We've got some great questions. Jackie and to team, in case you want to add into this, but we got a question here. Understanding and managing net transaction cost is a challenge we've seen with some of our clients. How do you help clients get a better handle on this and or educate our boards and leaders to avoid disappointments or surprises?
Yeah, so I mean, I think there's a couple things going on there. So I particularly because of the clients that we work with often are, VC backed and startup companies. Obviously, legal expenses are a huge, can be a huge surprise for people in a transaction. And so we try to be very upfront, right? So do you, understanding what the lawyers are going to do, what the lawyer's not going to do, what's going to be handled internally. I think that's generally one way to at the outset think about fees. Also, so I think legal fees, and then obviously, if you've hired a financial advisor, that's going to be a big expense. But then on the legal side, we can definitely let you know what to expect in terms of other fees. And I think it's, again, to my point about sort of mirroring the IPO process. Oftentimes, lawyers don't get in front of the board until just before the transaction when we're talking about approving it. Happy to always do it. And you should always ask your lawyers, come and talk to the board, explain what's happening in the transaction, give them, and let them hear it, not just from the CEO, but let them hear it from the lawyers, give an update, and then, start circulating that waterfall in advance so that there is no surprises.
Amazing. And David, we've got a question for you. Do you do success-based fees until I close my first couple deals?
So I'll take the KPMG side out of this. Sure. I mean, success-based fees are fairly common in the market. I would say they're more common on the private equity side where there is a significant volume of transactions going through. I think on the corporate side, it might be like a once a year or twice a year. And so, obviously the risk tolerance of that is a little bit lower. But at the macro level, sure, right? I think, advisors can be relatively creative when it comes to, how we make a return for the advice that we are providing. And again, in the private equity market, Colin, it's pretty common.
Yep. And Caitlin, you talked about your nice dinner with all the advisors. Speaking of advisors, so what are your thoughts on a professional shareholder rep?
I haven't worked with one, to be totally honest with you. But I am of the mindset of, the right advisors are the right advisors. So what I think is more detrimental is having disruptive advisors in there across the board than not having the right advisors. So I don't know who's in the audience, and I'm going to be a little bit cautious on that answer.
Colin, can I take that one real fast?
Yeah, of course. Yeah, I was going to open it up.
Yeah. So assuming that I'm understanding the question, and it's sort of a post-closing mechanism. So they get hired in terms of the deal, but they look at the merger agreement or something, but they're really the post-closing person that gets called for a purchase price adjustment. So the buyer doesn't end up dealing with 100 or 50 or something stockholders. Highly recommend them. They are very useful. They're not super expensive. We're talking like maybe $30,000 to $40,000. They can be cheaper, and I work with all of them, and they often will beat each other's pricing. They're not going to go down to like zero, but they are very competitive in pricing. The number one thing to think about is, particularly if you're a founder, if you are the person that becomes the shareholder rep on behalf of everybody, because buyers will require it if there's a bunch of stockholders, if you are working at that buyer going forward, it's not the place you want to be as a founder. You do not want to have an employee, you do not want to be an employee and then as an employee sort of on one hand, and then an hour later, you're arguing on behalf of your stockholders. It's not good. As a buyer, I always, on buy side, I always tell my client to not accept that and to get a professional, to require a professional rep. So they are very useful.
Todd, anything to add there?
Not on that point. I think
Okay, great. Let's see another question here on, let's see. M&A is a relatively common exit route for pre-early revenue medical device companies. Any guidance for the sell side on valuation for these kinds of companies? It's a valuation question over to David.
Not really. There's a bunch of valuation people in KPMG who can speak to it much better than I can. I guess valuation of pre-revenue companies is always challenging, right? So it's like, upon what basis do you perform your valuation? But I would probably speak to someone who's an expert. Maybe Caitlin could chip in here.
Yeah, Caitlin.
I would also healthcare expertise and valuation. We've got someone, and I'm not going to step on his toes to answer that question. So we can get back to you.
Okay, all good. Yeah, we'll provide a link for everyone to raise their hand in case they want to learn more from each of your respective companies. Let's see, Todd, What extent does rep and warranty insurance carrier get involved with the reviewing, approving reps and warranties?
One more time, Colin.
Oh yeah, what extent does the rep and warranty insurance carrier get involved in reviewing / approving reps and warranties?
So it's a pretty involved process. The rep and warranty insurer themselves will re-diligence all of the different diligence streams that have already been completed. Tax, legal, insurance, QV, all of that's going to be re-diligence. And there is a diligence fee for rep and warranty insurance as well. For that cost, you get the insurer themselves re-looking at everything. So this goes back to the point that I mentioned. And my colleague, Emily Mayer, is going to be on the second portion. So there's going to be a lot of rep and warranty discussion, and she's an expert in the field. But it is really helpful to have that second set of qualified eyes, find something, should there be something wrong before the transaction closes. And that can be done during the rep and warranty review process that the insurer finds. Yeah. Good question.
Yep. And I have a feeling this is going to be it depends answer, but they also ask, can you give us a sense of premiums?
So the premiums have come down in the last few months. And this is another, it's funny that Emily's speaking a little bit later, but it's a lot better than it was in 2020, 2021. On a percentage basis, it's probably right now between 2.5% to 3%. Of the limit purchase. And so it's a little bit more affordable. And when compared to 2021, that was probably right in the 4% range.
Amazing. Super helpful. All right. So the panel mentioned getting your finances all wrapped up to get the books updated and get personal out. I guess I'll just offer this up to the group. Can you give more detail on this? Financials for them is what's happening and what's projected. So what's expected for each?
I can probably take it, but can you clarify the question?
So the getting your books updated, getting your personal out. Can you give more detail on that and how to, I guess, understand what's happening now and what's projected and what's expected for each?
Let me answer a question that I think I can understand. So obviously getting a set of historical financials, audited financials ideally, right, and then a set of projections is really, really important as part of a preparedness phase. I think the more confidence that buyers have in the robustness of your financial, historical financials, and the robustness and your ability to talk through and articulate what your forward-looking projections look like, I think it gives buyers really a lot of confidence. Again, it's one area that advisors can be really helpful in. Bankers can be really helpful in that kind of thing too. I think it's really, really important because actually when you're in management sessions and if you're not able to articulate, hey, look, why we've seen these particular variances in business performance, for example, or what some of the key metrics are, or hey, look, why do we expect this particular outlook versus the kind of outlook? Everyone's very familiar with, hey, all this stuff hockey sticks up to the right. That's the kind of standard, sell side set of content that we see. But actually, if you can't articulate why, right, what's driving the underlying performance, how you're able to beat market, right, and therefore acquire share, et cetera, then I think it falls apart pretty quickly. So I think being very clear about, this is why stuff's happened in the past, right? This is very explicable, right? And then this is why we expect the business trajectory to be better in the future and how we're going to invest and how we're going to put, the investment to good use to do that, et cetera, I think is really important. So I think that's a really good answer to the question that I would have asked, but I don't know whether that was actually the question that was asked.
I believe that was it. I'm just navigating, the wording on these. Let's see.
Colin, sorry to interrupt you, but the only thing I would add, and I completely agree with David and everything he just said, from a capital provider standpoint, projections used to be a little bit of a joke. And we used to laugh when you're thinking about getting your debt in order, take those projections, we'll just make up our own, right? We'll just take what you have, add the 3%, et cetera. I think 2020 really shifted that. And there's a whole lot more weight in really understanding what's about to happen in the next 5 years for a business and why. And so to the point David made of being able to articulate through your projections, that's really important. And making sure you did the projections more than just a percentage revenue growth on this, this, and this. It's, hey, what's happening at the contract level? What's happening at the relationship level, the cost level, this salary, how many people are you going to hire? It's getting a lot more detailed in how we do our analysis as capital providers. And so that plays into the M&A process as well.
Super, super helpful on the evolution. Todd, how does IP due diligence affect insurance premiums, if at all? If the target company operates in a crowded IP field, how important is IP due diligence?
Yeah, I mean, that's a good question because there's specific fields where M&A transactions have a little bit more nuance, and IP is certainly one, right? And then, we talked about rep and warranty insurance ad nauseum today, probably for some, and for some, may have been interested, but there's certain classes of business as well that rep and warranty insurance carriers are a little bit more squeamish to be associated with or do deals with. Healthcare, when there's Medicaid and Medicare would be one. IP, they're going to have specialists, and so similar to what we talked about with up-leveling and having the right advisors on hand, you're going to need somebody that has IP expertise from a legal perspective that can help nuance that and provide all the right pieces of information to each and every party that's interested so that everything is protected, because it can be a challenging thing for insurers to get their arms around. And sometimes they look to the experts to inform their own opinion. That's what I would say.
Thank you. Yeah, that's great. Let's see, switching gears here a little bit, given the discussion on the importance of M&A advisors, what's the panel's view on human capital advisors in preparing for M&A? Anyone got that one?
Yeah, I'm happy to take it. So, I think it's really important. Cultural fit, for example, right, is one area where our human capital advisory folk, look in real detail at. I think that's really important to make sure there's going to be, kind of cultural harmony, right, between buyer and seller. And then obviously there's then all of the, HR related issues that some of which we touched on during the panel, right, and making sure that we have a good handle on, hey, look, how does, the existing benefits package, for example, of the seller map to, the benefits package of the buyer, for example, how does the leveling work? So, generally people in smaller companies have more inflated titles than you see in larger buyers. So how does that map across, and how do we then make sure, we don't have a big, churn spike, right, and we're able to retain key employees, et cetera, et cetera. And again, I just think, this isn't kind of banging the drum for advisors, but, sitting with people who have done this, hundreds and hundreds of times and have a real nuanced perspective in terms of, what are the risks that we face and how do we address the risks that are out there. I just think it's really, really important, and especially in, a lot of the M&A that I do is more around services, right? And, services is all a people business. And so if people are disenfranchised and they leave, then you basically, there's not like additional IP that you're buying. The IP is in the people. If the people get disenfranchised and leave, then, you've eroded the value of what you've bought. I think it's really, really, really important.
Amazing. Thank you, David. And Jackie, you went off mute in lightning speed after I asked that question.
Yeah, no, the only thing I think David hit it. I think I would just clarify that this is really something that a buyer would be focused on. I think important to keep in mind, that on the sell side, you're really focused on stockholder value. And so, yes, these things are important, but I think thinking about strategic and long-term, who's going to fit in where at a buyer, I think very much a buyer-centric point. So just wanted to clarify that. But.
Yes, thank you, Jackie. Thank you for doing that.
All right, we're almost at time, but we got a couple more questions here. We have our buy-side panel next, but we do have a buy-side question. I know all of you have a little bit of experience with the buy-side. So how can buy-side deal makers create internal momentum after a dry streak, AKA the past year, through this year's environment?
Colin, was it buy-side advisors or companies?
Buy-side deal makers create internal momentum. Yeah.
Okay. I can take it a little bit. I think, a couple things we've seen as trends in the buy side markets are really, really niche industry experts. So for example, I'll pick an industry, engineering and construction. There's a lot happening in that industry as a whole, but they are very specific in terms of what they need to grow their business, which is great. So if you can, as a company, as a strategic, you have to have that articulated and what you're looking for and why and what returns, et cetera, what products and markets do you need to get to. But it can be really challenging to go and find some of these players in such fragmented industries. And so we've seen a lot of really niche advisors come together who specialize in HVAC in the Southwest and finding these types of businesses. And so that has become a little bit more fragmented. And I think knowing the industries that you're playing in and the parties, that's one way.
Awesome. To our panel, anything to add to that? Caitlin,
No,
knocked you
I
out?
mean, the only thing I would add probably is, like all kind of business development type activity, if you go out and kind of shake some trees and meet people and go to industry events, right, and call your bankers, I still think there's lots of deals to be done. You just need to kind of shake a few trees, I think, to make it happen.
Love that. Well, we are about to hit our break. So David, Todd, Jackie, Caitlin, thank you so much for sharing your insights on the sell side today. Really appreciate it.
Thanks, Colin. Thanks, everybody.
Thank you.
And for those of you still on, if you want to get a meeting with any of our partners on this call, I'm going to launch a quick poll right ahead of our break. If you want a follow-up meeting, learn more from KPMG, BMO, Wilson Sonsini, Woodruff Sawyer, or Microsoft Entrepreneurship for positive impact, let us know and we will give you their contact information. Of course, we would love to connect you. Let's see. Alrighty. Well, we are emerging on our break. So thanks for participating in that poll. Hang tight and we will be back at 10:25 p.m. Pacific Standard Time. So be back in 10. See you in a minute. righty, welcome back. For those of you just joining us, we're going to be opening up for live Q&A at the end of the panel. So if you didn't get your question answered in the first, please submit those questions for us in the Q&A function at the bottom of your screen throughout this discussion. As you settle in, I'm going to launch a quick poll just to get a gauge on how many acquisitions are you planning in the next 6 months. So is it 0, 1 to 3, 3 to 5, 5 to 10? This will help our panel understand where you are in the process and what your activity looks like. All righty. I'm going to let this roll for just another couple of moments. Thank you for participating. Now, let's see. Okay. So I'm going to end this poll, share those results. Looks like 1 to 3 is in the lead at 50%. Followed by some who are just looking to learn more, and then 3 to 5 and 5 to 10. So thank you for participating on that. Let's see. So on to our topic, growth through acquisition, buy side over and insights. Without any further delay, please join me in giving a warm welcome to our guests. We have Mark Holloway, who's a partner at Wilson Sonsini, Emily Meyer, who's a senior vice president at Woodruff Sawyer, and John Milner, who's an M&A advisor at KPMG. Welcome, team. Hello, hello. Welcome, Emily. Welcome, John. Welcome, Mark. Well, just before we jump into this discussion, let's just do a quick round of intros to talk a little bit about the work you're doing in M&A. Emily, I'm going to start with you.
Hi, I'm Emily Mayer. I'm a partner at Woodruff Sawyer, which is a full-service insurance brokerage firm, and I head the transactional insurance unit, which is the rep and warranty, tax opinion, litigation buyout stuff.
Love it. John, over to you.
Yeah, John Milner. I'm a partner with KPMG's deal advisory and strategy practice. And so I help guide my clients through an entire life cycle of an M&A transaction, from pre-signing due diligence, strategy, right through execution, and through post-close value capture. So think integration, synergies, growth, all the things that are why you did the transaction. And I spent most of my career focused in the technology space and helping those clients execute deals.
Thank you, John. Mark?
Hey, thanks, Colin. Mark Holloway. I'm a partner at Wilson Sonsini, based out of Washington, D.C., and I head up our East Coast and our transatlantic M&A practice. We're focused on technology and life sciences companies, so that's where I do the bulk of my work.
Great. Well, let's jump right in. So we spoke 6 months ago. So how has the buy side changed from your desk since we last spoke? And how hasn't it? Emily, I'm going to start with you.
It has changed a little bit, very, very recently, but I would say it's only very, very recently, and it's only changed a little bit. We are seeing that sort of end of summer, beginning of the fourth quarter ramping up of activity. But I'd still say that we're seeing predominantly smaller size deals, and quite across quite a wide variety of different industries. I'm not seeing, apart from the sort of usual healthcare stuff, I'm not seeing a massive concentration in any one area.
Mark?
I would agree with everything Emily said. The way I look at it is, I think in the prior quarters of this year, buyers were doing layoffs. Buyers were worried about, especially in the technology sector, you've got layoffs, you've got banking uncertainty, and I think they're really focused internally on what does this new economic environment mean for us. With the recent uptick in thinking about deals, not necessarily doing them, but thinking about them, I get the sense that people have sort of righted their ship. They're thinking more about their strategy. They've realized that there's ways they want to grow inorganically, but they're not fully committed to actually doing the deal. So a lot of nibbles, a lot of green shoots, conversion rate still pretty low.
And John?
Yeah, I mean, I agree with both Mark and Emily. It's been obviously a very slow deal market for the last 12 to 18 months. Starting to see maybe some green shoots. I don't know if that is just the post-Labor Day bump that everybody kind of held sell side mandates going out into the market until after Labor Day. And so we've gotten a couple week bump in terms of start of activity, but it still feels like people are trying to understand what is the environment, and more importantly, how do I get confidence and some certainty around how I'm going to transact, whether that's from a valuation perspective, a rates perspective, or other macro factors.
And to build off that, John, how's your bandwidth changed in the third quarter? Are you ramping up? And how are your buyers and sellers reacting in this market?
Yeah, I wish I could say that we're all ramping up in terms of new mandates and projects, but no, I mean, it still remains a pretty subdued market. I really think that there are kind of two halves, if you will. A lot of we've mentioned it, there's a lot of uncertainty, be it rates, be it macro factors, companies laying folks off. Tech, which is my world, was kind of the first industry to really decline in terms of volume and activity in M&A. And historically, it's been one of the first to come out of that trough. We haven't seen that inflection point yet. I'm hopeful that that's something that is coming soon. But for now, I still see a lot of buyers looking at opportunities, but nothing's really moving very forward. And a lot of that has to do with the fact that the population of acquisition targets, so the sellers that are out there in the market right now, there just aren't that many. And you really kind of have two halves going on, which is some really attractive businesses that are still commanding valuations and the like that people are going aggressively against. There's just a lot fewer of them. And then there's a number of sellers in the market that just have to be in the market. And when you have to be in the market, it's not a great place to be.
Thank you for that. Emily, how has the rep and warranties market evolved since we last spoke?
It is always the canary in the coal mine of M&A activity. My bandwidth has got more busy, but not necessarily with deals, but with new product development. What I'm seeing from the rep and warranty market is, well, there isn't a lot of M&A activity. People are looking at different ways to utilize that capital. So we've seen specialist products come in for very, very small deals that are written on a synthetic reps basis. Be interesting to see how those play out in a claims scenario. We've seen an incredible willingness, a flexibility around litigation coverage, which we had not seen until fairly recently. Things that I didn't think we could get coverage for, it turns out we can. And there's a lot of interest and a lot of noise around tax. In terms of rates, which I think was asked about on a previous panel, we're seeing sort of 2 to 3% rate online on the limit that is bought, not the enterprise value, which is sort of 2018, 2019 pricing. The more interesting thing to me is the drop in retention. We were pretty consistent at a 1% of enterprise value for retention. We're seeing that drop to 0.75, 0.5 of a percentage. I expected that to happen on the bigger size deals. What I wasn't expecting is for that to happen on the teeny tiny deals. And that is even happening on the teeny tiny deals, which I think will be really interesting in 24 to 36 months in terms of claims payout. One of the criticisms of rep and warranties was always that the claims came within the retention. I think that's not going to be the case going forward. So very pleased to see that. And the amount of competition in the market for any individual deal is phenomenal. So we're taking this opportunity to really push back and create precedents that underwriters will hopefully come to hate as the market picks up.
And Mark, to build off that a little bit, do you see anything on the buy side slowing deals down, considering the competitive market?
I think the biggest thing slowing things down is that, while buyers are now willing to think about acquisitions, I get a consistent vibe from them that their risk tolerance is really low. So really strong companies, cash flow positive, high growth rates, very clean from a diligence standpoint, that have a real shot of maybe going public or easily raising additional funding. Those deals are sort of easy to get done because the buyer can say, well, this opportunity could go away, right? For pretty much everybody else, where fundraising may be difficult, they may have a little bit of dust bunnies on the diligence front. Buyers' risk tolerance can kind of lead to those deals falling over, which we've been seeing a lot of.
Helpful. And John, speaking of deals, how has pricing for buyers been impacted over the last 6 months? Can you talk about the root cause of this, hinting on the valuation front?
Yeah, it's really building off of what Mark just talked about, right? You've got this tale of two cities, if you will, where you've got really attractive assets, really attractive companies that don't need to come to market but can. and are really opportunistic, and those are still commanding really good valuations. I mean, kind of where we have been historically, but there are few of those. This isn't really the market where you can go back and open up PitchBook and say, pick an industry, pick a deal size, and look at an EBITDA multiple and expect that that is representative of the market. This is really where we've got a number of transactions happening still at the top end of that value range, and a lot of transactions happening lower down the value range. I recently helped a client acquire a business that was, basically they paid the cash on hand, and so they got the company for free. We're seeing things like that come out just because there's distressed businesses, whether or not it was a good business or not, they're ending in a position where in the current environment, it is really hard to raise capital unless you have a very clear path with the unit economics to profitability and cash flow. That's really challenging, and that is putting a tremendous amount of pressure on valuations. And so this really is a environment today where there is no average to the market, if you will. It really is situation by situation, more so than I would say over the last few years. So it's been really interesting to see that dynamic unfold and how buyers are choosing to either play up in the market because there's really strategic assets that they want and they want to take advantage of it because they just have to when it comes to the market. And on the other side, people being advantageous around some distressed deals. Maybe there's some good IP here. Maybe there's some good talent or like that I just couldn't have touched in 12, 18, 24 months ago. Now I can. And that becomes attractive to some buyers here where maybe there are the dust bunnies around the due diligence and the like, but underlying strategy behind this is if I've got capital and I've got a longer term view, there might be real value here and it might be a real opportunity.
Super interesting. Emily, you mentioned a little bit, and I'm going to double click on this point that you mentioned that pricing for reps and warranties insurance has gone back down. Any reason for this? And do you see the trend continuing?
Yeah, it's really interesting. What we saw at the end of 2021 was, a sense from underwriters that money had got left on the table because they did not have enough staff to underwrite this sort of incredible quantity of deals. As a result, everybody staffed up massively, right? And we've had, even this year, 2 new, and I think we're about to hear of a 3rd new entrant to the underwriting market. So we've got 26 probably coming up on 27 markets with a lot of mouths to feed and not enough deal activity. And that's why you've seen this this plummet, for want of a better phrase, in pricing. What's interesting, and referring back to my previous comments, we've also seen a spike in claims, right? So we've got sort of the worst of both worlds going on, where we've got pricing going down and claims going up. Now, we see a spike in claims for every line of insurance whenever there is any kind of concern in the economy, right? Because the minute there's a concern in the economy, we all start looking at where we could possibly get money from. So I'm not saying that spike in claims is necessarily going to lead to a spike in payments, because there will be a lot more sort of speculative claims that come out in the rep and warranty market. But we also saw a huge amount of deals getting done, and those are the ones that are now coming home to roost. And we saw those deals getting done under tremendous time pressure and under tremendous advisory pressure, which means the likelihood that things were missed and the underwriting was done on a super fast basis is higher than you would see in a normal market. So I do think we are going to see an uptick in totally legitimate claims payments. But while we continue to have this downward pressure as a result of new markets coming in, which is beginning to border on the farcical now, and the amount of people that are now in the ecosystem of rep and warranty insurance, I don't think I have seen one quote below 2% for a super vanilla and desirable risk. I am hoping for the long-term health of the rep and warranty insurance market that we will not see much in the way of further dip, because at that point, when you're talking about a policy that runs for 6 years, right, financial security of your underwriter is incredibly important. And so if they start sort of cutting each other's throats to the point where financial solvency becomes an issue, right, then people lose confidence in the market. So I'm hoping we won't see much more of a further drop. What I think we will see is a continuing pushback from those of us in the broking community on terms, conditions, exclusions, right? We went from a situation a couple of years ago where, nobody could get prosecution costs to now everybody's offering prosecution costs. And some of those are even offering third-party prosecution costs, right? So I see the numbers staying fairly stagnant, hopefully, but further room to maneuver on terms and conditions.
Super helpful. And I'm going to propose this question to the group, but I'll start with you, Mark. Can you discuss how private equity activity has been affecting the M&A market from your side?
Yeah, absolutely. So PE is always a factor. It hasn't been a big dominant force from what I've seen. And, from talking to our PE clients, they're some of the most rate sensitive folks out there, right? Strategic folks are impacted by higher interest rates as well. But, private equity folks are real, dedicated to their models, right? And the cost of capital really influences decision-making. I've seen a follow-on purchase of a portion of a JV that a couple of years ago was, a couple $100 million. Now it's being sold for $10 million because it's a very capital-intensive business. And so you have one private equity firm saying, you know what, I don't want to put any more money into this. So happy to walk away. A lot of kind of noodling around the edges of existing portfolio companies, right? Is there third-party debt? Can we buy it back at a discount on the view that this company can't service that debt, right? And so, we can go insolvent, or you can sell it to us at a haircut. A little bit of add-on activity to say, well, maybe we'll bring in some higher revenue multiple smaller businesses to kind of change the overall story about this asset. But a real reluctance to kind of sell any big asset right now, given that they know valuations are depressed. What's kind of interesting, I started to see some articles about whether there is a kind of overhang building in the private equity space, that, these funds have a certain life cycle and they've got to basically exit their investments and return capital to their limited partners. And so, how long, if this slower deal market persists, how are they going to manage all these companies that they really should have exited? So it'll be interesting to see what that looks like in the coming years.
Super interesting. Emily, how are you seeing private equity affect your work?
What's interesting, Woodruff is, I think, fairly unusual in that we have a pretty 50-50 split between corporate and private equity. We're heavily tech focused, but split between those two areas. I expected PE to be a little bit more opportunistic, but they're still taking their time. I read somewhere that it's supposed to be there's supposed to be 30 to 40% of deal activity in this year. And that feels about right so far, in the sense that I've actually seen our corporate clients being a little bit more opportunistic. And I think it probably goes to what Mark is saying about being a little bit less rate sensitive. So we're seeing more of that. Again, on both sides, what I'm seeing is the smaller deals, right? It's the roll-ups and the sort of extra acquisitions, the add-on growth. Although interesting to see that the FTC is going after private equity in healthcare. I think in Texas recently around a particular area. So I don't know if the FTC getting more interested in sort of smaller acquisitions and their overall ability to impact competitiveness is going to have an impact on PE, because that does seem to be more of their strategy right now. But we are seeing our corporates coming back to the table, but I'm still seeing an awful lot of, we're starting a deal, we're going down the road. Ooh, hang on. There's, the financials of this quarter didn't turn out to be exactly what they thought they were going to be. We're just going to put this on hold for a minute. So, and I'm seeing that from both sectors. That usually means on the PE side that they're going to renegotiate the price. And on the corporate side, it tends to be that they're going to sort of walk away. So I'd say everybody is still being true to form. But I was surprised by how opportunistic some of our corporate buyers are, as they are generally find it harder to make a consensus decision as you require more people to agree in a sort of corporate acquisition than you do in a private equity one, as a general.
That's great. John, anything to add on the PE M&A market side?
I mean, I agree with both Mark and Emily. It's a pendulum that swings, and right now, when we think about executed exits or acquisitions, PE is declining in that mix for the reasons that everybody's kind of talked about already. But if you take a step back and you look at private equity as a whole industry, and I have a little bit more than half of my business in private equity, that industry continues to grow in terms of asset under management, the number of funds, not just in terms of the number of funds within a private equity fund itself, but also the number of private equity funds and managers that are out there. And that business continues to grow. And the thing that I keep reminding myself about this industry is that these are very smart people that are paid to do deals and paid to drive value for their clients, right? Their economics are around raise money, deploy that money, and generate a return on that money. And so as I talk to my private equity clients, while they're not executing a lot of transactions, maybe there's some little roll-ups or some add-ons that they're doing within their portfolio companies, they are actually pretty eagerly waiting assets that are interesting to come to market. The reality is a lot of the assets that are sitting in the market today aren't very interesting to them because they're kind of more distressed. They have a lot more hair around them. They're not a story that fits a private equity buyer that is saying, I've got a fund cash flow and the like. They're more growth stories, investment stories. And so as that market will change over time and more assets come to market, private equity will come back very quickly there. They're all sitting there waiting. In the meantime, they're all focused on what am I doing in my portfolio companies to drive growth or drive value. And if that comes in, how do I try to change pricing or the like and improve commercialization or adjust my cost base? I mean, what has been a really interesting conversation, and it kind of moves, it ends up in an M&A outcome sometimes, is a lot of companies are sitting there saying, my growth wasn't what I expected it to be. So what are the other levers that I'm changing? And what am I going to go divest, or what am I going to go fit in my strategy in order to kind of get back to something that becomes attractive? Because as Mark talked about with that timeline with their life cycle, at some point they're going to have to get rid of these assets, and they've got to have a little bit of a track record to do so. So they're sitting there in their portcos right now, trying to optimize those. But I think as soon as things come back to market, we'll see them come back very quickly in the M&A space.
Yeah. And John, to double down with you, what metrics are really important to measure as you're talking about what these new buyers are looking for new deals?
Yeah, in previous kind of conversations around this, we would have talked about how you drive conviction around the valuations that you're paying, because valuations are so frothy, or were. Today, really, I think it comes back to where M&A has historically been outside of the bump that we had kind of post-COVID, which is really around, why are we doing this? What's the strategy? I mean, I think today more than ever, especially for strategics or corporate acquirers, it's, why am I going to do this? The metrics almost become secondary to the strategy today, because you've got great assets and you've got assets that it might be the diamond in the rough for you, but it might be rough for somebody else, and you've got to figure that out. So what I'm seeing a lot more of my corporate clients doing is building out their target list, right? I mean, best practices are this is the universe of companies I want to track to see when there's an opportunity, because it's a competitor, it's an adjacency, it is some sort of extension or has some technology that I want. They're continuously refining those target lists so that when that opportunity arises, they're ready to jump on it, because they will happen and they will move relatively quickly. But it's getting back to that strategy of why. They want to minimize the disruption, especially in today's macro environment. M&A is incredibly disruptive, it's expensive, it's time consuming, takes your eye off the ball of running the business. Like, you want to minimize those things today so you can continue to grow on the core. And so people really aren't pulling the trigger until they really believe and trust that strategy, that this asset is going to help them grow that strategy.
Awesome. Mark, over to you. Many serial acquirers have changed the way they're looking at deals. So who do you see has more power at the table in Q3? Has that evolved? And are there any changing terms or any trending things that you're seeing?
Yeah, I think that's certainly true, and I think John did a good job of kind of delineating between the two generally different kind of deals out there, right? You've got some people that are really, you've got some targets that are really strong, right? They could potentially go through an IPO. They don't need to do a deal now. They can raise additional money, right? And those deals don't feel that different. There aren't a ton of companies that are that strong though, because I would say that buyers have really turned up the knob on what qualifies, right? I started an auction process earlier this summer for a company that was, cash flow positive, good growth. And they're involved in some lawsuits that implicate how big their total addressable market is. And, if you'd asked me at the start of the process, whether this was going to be a relatively easy deal, deal to get done, we're going to get some offers and have a price that people are happy with, I just said absolutely yes. And 201, the many tens of buyers that were asked basically said, we don't know what to do with these questions about the total addressable market. One person showed up with a price which was 50% or less of what people were hoping for, right? And so it's not even so much that the leverage is turning into I'll buy your company at a stark discount. For the most part, it's I won't even show up. Almost every auction I've done this year has failed. Nobody comes to the table, right? And I think for the most part, it's that there's that risk tolerance is just so low that I'd rather not do anything. I don't want to make a mistake. And I think for the most part, buyers can really afford to do that. What's the alternative? Most companies are not going to go public. The capital markets, despite a few recent IPOs, are still, pretty cold. And you see a lot of companies that they're either going to sell or they're going to have to do a painful down round and, agree amongst themselves that the valuation that they did in the last 24 months was way too high relative to current market conditions. And so do you want to be the buyer that wades through all that and deals with a bunch of unhappy shareholders? Or do you say, this company's not going anywhere? They can probably raise money. It's going to be a painful down round. They'll have to have all that conversation without me involved, right? I can probably come back in 6 months if I really want to, and still do a deal, right? Because there's very little competitive tension for most companies to get out at this point. The other thing I see too is that you get slightly a different flavor of deals. Companies more willing to think about like a divestiture of a piece of the business that's not that critical as a way to have sort of non-dilutive financing. And also seeing some, you're not sure who's the buyer and who's the seller, but two like private companies combining on a stock for stock basis on the theory that with a diversified portfolio of products or drugs in the life sciences space, maybe we're more attractive to venture capital deals or venture capital, fundraising. And so those are pretty interesting. You see less of that, when people think they can do a full exit, for cash.
Super interesting. Emily, what's your advice around due diligence for corporate buyers? Anything to look out for? You're the reps and warranties pro here.
Well, what I'd say is if we look at the claims history, that tells us where people are generally finding problems or where diligence is sort of falling apart. It's not fair. The leading sort of cause or given reason for rep and warranty claims is an issue with the financials, but that is misleading because a breach of one rep is almost invariably also a breach of a financial rep. And so as you bring claims for breaches of multiple reps, that can sort of look like a misleading figure. What we're seeing an increase in is, compliance with laws, regulatory issues, tax issues. Those are the areas where sort of problems are found after the event. And I would also say, just as a plug for my own industry, we're dealing with a situation right now where if someone had looked at the asset valuation on the insurance application as opposed to the asset valuation on the balance sheet, they would have seen that the insurance was vastly undervalued, and that had been done for the previous couple of years before acquisition. And so when they then went to appropriately insure that company, it actually sort of put a major dent in the model. And so I'd say it's sort of it's the little thing that's going to compound year after year after year. And then the other area where we're seeing an increase both in rigor from underwriters and from buyers is on contracts, right? The assumed contracts of suppliers as well as the assumed contracts of customers. And those are getting a deeper dive because we're seeing a greater increase. And I think that might be sort of a COVID impact several years down the line. The increasing concern around whether your suppliers can supply and whether your buyers can actually buy after the acquisition.
Yeah, that's super helpful. John, anything to add on the diligence front from KPMG and your perspective?
I think a lot of it has been covered. It's really about going deeper. I mean, we were in a situation, after COVID or during COVID, depending on how you want to classify it, the M&A market really accelerated. And deals were getting done really, really quickly, and diligence became not an afterthought, but people were finding ways to shrink the period of diligence, shrink the scopes of diligence and the likes. And, like with everything in the pendulums, we're seeing the other side of it, which is the repercussions in terms of claims coming out of, maybe not enough diligence. And so it really, in my mind, is about risk adjusting the diligence that corporate buyers are doing so that we are addressing the totality of the risks appropriately and not trying to think about it as a tick the box, let's move forward, but really using it as a way to identify levers of value and risk in your transaction.
And Mark, you've seen some deals stall and some deals go across your desk real quickly. And as John was talking about, there's several factors for that. So can you talk about some of the deals that went quick and why?
Yeah, I think, the deals that went quickly, couple of factors, right? You've got very, very dedicated people. I had a pretty memorable deal over the summer that got done in about 3 months, $1 billion plus, very strong company, a CEO seller that refused to let anybody leave calls for conflicting obligations. And at first we thought he was joking, and we said, like, what do you have to do besides, do the 4th largest exit in this country? And we're like, oh, haha. And he's not joking. It's like, everybody stays here with me until we're done. Right. And that kind of commitment to, hey, come hell or high water, we're going to push this thing through. That commitment by the principals is really important. And also just the absence of any sort of external factors, right? Do you need regulatory consent? Do you need third-party consent? Do you need financing? If you need any of those, that makes it harder, right? Because then you've got to think about what's the motivation for those folks, and are we willing to wait, right? Or are we willing to sweeten the deal such that they've got real reason to move faster than usual? A lot of distracted parties in the market, depending on what's going on with them. But that's from a speed perspective. I think it's the commitment, and it's that lack of any real, everybody here at the table is all we need to get this deal done.
And Emily, given the dynamics of the year and quite frankly, for the past 3 years, any advice for our corporate buyers out there?
I think, the corporate buyer, to my mind, looks at acquisitions differently than the private equity buyer, because it really is, that they're not looking to buy something, grow it and sell it, right? They're looking to expand, and they're long-term holders. And so what's interesting from an insurance perspective is that when a corporate is buying another entity, they usually have a very strong understanding of that industry because it's within their industry scope. And so the things they focus on from a diligence perspective can be very specific, whereas private equity will sort of look at everything on a much broader base. When it comes to the rep and warranty insurance, underwriters are expecting that broader base style of diligence. And we find that sort of the biggest hiccup with the first-time corporate is we're looking for diligence, the underwriters looking for diligence in areas where they feel sort of super confident. And so that, well, we don't really see why we need to do diligence in that area because we kind of understand that problem. But obviously they still want coverage for that area. And it's just the function of the process that it's usually useful if we sit down with a first-time corporate buyer and talk about diligence from a rep and warranty perspective, where they'll be looking at sort of instead of going super deep in one or two areas, they'll be looking for it to be all areas, but not necessarily quite as super deep. So it's just a different way of approaching risk, and a different way. There's more often internal diligence done with a corporate buyer. For that reason, they have specialty in that area, and that's fine. But it needs to be memorialized in a particular way so that it's sort of digestible by the underwriter, who is essentially doing diligence on the diligence that's been done. And so just saying we looked at it is not super helpful. They actually want to see what was looked at and by whom and what was the outcome, et cetera, et cetera. So I would say to our corporate buyers, it really is, if you do want rep and warranty insurance for this particular transaction, getting a sort of a handle on the expectation, which will probably be different than how you're used to doing it internally, will solve you being hugely annoyed with me later on.
John, any advice for our corporate buyers out there?
I mean, I'll continue to echo and maybe extend what Emily was just talking about. It's a really interesting dynamic when you think about first-time corporate buyers or corporate buyers that really don't transact often, and so they don't have the playbook, they don't have the muscle memory. I happen to work with a handful of those because they always come up every year, and I have a handful of acquirers that are have entire teams dedicated to executing M&A, and they've got playbooks, and they know exactly where to attack diligence, how to document it, how to go through all of the functional areas and do all of the planning, the diligence, the execution, the reviews, the alignment internally, and the responsibilities. And I think if you're a new corporate buyer or a new corporate buyer, finding really good advisors, and not just trying to plug the three of us sitting here on the webinar today, but take their advice, realize it's going to be expensive. The biggest problem that I see is people say, we don't need to do that. I don't think that's relevant here, but it's coming from a place of unknown. They don't know why it's being done and the like. And so I think having a little bit of trust and just finding really good advisors to help you there is really important. If I take that hat off, and I think maybe a little bit more broadly, I think Mark mentioned it really well earlier, which was, you don't have to do a deal right now in this market. Maybe a year, 2 years ago, you needed to do a deal. Today, you've got time and optionality. And so it kind of comes back to saying, why are you doing this? And are you doing it for the right reasons? Because you don't necessarily have to do it right now.
That's great advice. Mark?
Yeah, I think John was absolutely right to touch on the playbook. There was an article in the Wall Street Journal maybe a week or so ago about some new academic research on whether M&A adds value. And it was a little bit more positive than some prior studies that really questioned, are buyers able to realize value in M&A? And one of the studies, or at least one of the things highlighted in the Wall Street Journal article, was that serial buyers tend to fare better in this, which for people that are involved, in the industry and do this on a daily basis isn't surprising at all, right? Because those are the folks that they've got procedures in place. They have a whole team of people thinking about, to the extent we need to grow inorganically, right? We can't build this ourselves. We've got to go acquire it in the market. Have a sense of what the total market looks like. If we don't buy this company, what's the next best option, right? And how many options are there? It totally makes sense. So I think this is a great opportunity for buyers, especially who don't have a really developed playbook, to kick the tires on things. Even where we're seeing buyers say, there's some diligence issues here, the price doesn't seem right. If their work-life bandwidth permits it, take a pause and say, okay, well, what if this was the last potential acquisition target in this space, that we just have to have somebody in this space? How would we get comfortable with these issues? Because they don't have to now, but 2 years ago, right, they did have to get comfortable with it, or just potentially miss out because companies were flying off the shelves in a way that was exhausting, as I'm sure John and Emily feel the same way, and somewhat bewildering, right? Because we're looking at people that have pulled in 3, 4, 5 acquisitions that year. Nothing's been integrated yet. And it's like, do you really want to buy another company? And so I think this is a great chance to say, okay, what if conditions were different? How would we get comfortable with this? How do we evaluate the risk to the business, the cost to fix it? And rather than just saying, we don't have to worry about it now, let's walk away. Sure, that might be the right answer, but I think it's really useful to game it out a little bit around the table internally and say, how do we get comfortable with this? And if we don't do this deal, what else might we do?
Slow down to speed up. And Emily, are there any predictions? We covered the historical M&A activity and saw a little bit of optimism there, but any predictions on where M&A activity is heading in the next quarter for our corporate buyers or PE buyers?
I think everybody in our industry is wanting to be cautiously optimistic. Whether that's sensible or just hope is hard to say. As Mark was saying, there was a time period where we were constantly exhausted. I'd like to get back to that time period. It turns out, it's not as interesting as you thought when there's not much to do. So I remain optimistic. I do think next year is going to be better than this year on the grounds that it has to be. And but I do see the green shoots that everybody is talking about, and I'm hoping that if they don't turn into anything this quarter, it just shows that people are getting back in the mindset of looking at acquisitions and sort of revving the engine again and blowing dust off the diligence.
John?
Well, I certainly hope we don't go back to those exhausting days. Those were a little bit too exhausting, but I agree we need to be busier as an overall profession. My clients have been telling me, we think next quarter is going to be better. We think next quarter is going to be better. Those are primarily private equity clients, which, going back to my earlier point, is they're paid to do deals. So they're always optimistic that deals are out there. Sitting here about ready to roll into the last calendar quarter, I'm less hopeful for what Q4 brings. I think it's more of the same of where we are today, but I am hopeful that 24 starts looking better. I think there's a lot of, we'll get more certainty, I believe, around where rates are, which impact PE. I think we'll understand a little bit more where the macroeconomic environment sits, and then I think deal making will get back to moving a machine. But if I had a crystal ball, everyone would be hiring me. Probably wouldn't be here, but I do think 24 is I'm more hopeful about 24 than where 23 is. Not just because 23 was so bad, but I do see green shoots indicating that 24 will be better.
Awesome. Mark?
Yeah. I think I'm also cautiously optimistic. And how I think about this from a day-to-day basis, I guess there's sort of two ways to think about it, right? We all know there's a lot of macroeconomic factors that are not super helpful, right? We've got higher interest rates. We've got the concern about, to the extent businesses are tied to consumer spending and all, we've got the potential, end of people's pandemic savings. We've got the restart of student loan repayments. None of those are helpful, right? Things like what's going on in China, is that going to massively slow down and be a drag on the world economy? So those are all helpful. Anything that reduces uncertainty and makes buyers feel like, well, valuations have come down. Have they come down enough, right? Do we hit bottom and we starting to swing up? It is helpful. At the same time, like I said, there's no competitive tension in the market, and people will ignore all sorts of risk factors if they feel like they have to. And so while venture financing is down and hard, while commercial lending is, harder and more expensive, while the IPO market is quieter, that also is just sort of slack in the system. So you could have none of the macroeconomic uncertainty go away and other parts of the market start to break out so that, companies don't have to sell. They have other alternatives, and people just start ignoring the risk. So that's not so much an answer as it is a way on how I think about it every day. But either one of those things could be true, right? If the IPO market bursts to life next year, I think M&A activity will also pick up, even if the macroeconomic pieces don't, improve a whole lot.
Well, no one has a crystal ball, but cautiously optimistic. I love that. Before we jump into Q&A, if somebody was going to dial into the last 30 seconds of this panel discussion, or a minute or so, what's one key takeaway from the buy side that you want people to walk away with today? Emily?
Great question. I think join me in my cautious optimism would be what I would take away.
Awesome, John.
I'd say refocus on the strategy and why you're looking at inorganic growth, and keep that list of target opportunities fresh and revised, because there will be opportunities, but don't feel the pressure to execute now.
Great. Mark.
Yeah, I build off what John's saying, is it not just refocus on the strategy, but be confident in your decision making and think about, under what circumstances would I take on more risk, right? And when would I be willing to sort of dive in versus walk away?
Great. Well, we're transitioning now into our live Q&A. So if you haven't put those questions for our expert panelists, drop them into the Q&A box at the bottom of your screen. Let's see. Well, you were just talking about this, John, but I'll open this up to the group, whoever wants to jump on it first. So in terms of deal flow, how can a strategic buyer go about finding motivated sellers? And then they're asking in the healthcare sector specific, but also in general.
Yeah, there's really, if you're a corporate buyer, there's really two ways of meaningful deal flow that I've seen. The first is get to know the investment bankers in your industry so that they know who to call when they've got decks, and know them all, because every different bank wins different sell side mandates. So you want to make sure that, when banks have books that they're representing on the sell side, you're one of the people on their list of potential investors or buyers, so that you're getting a call. The second thing is, and this kind of comes back to what I was mentioning earlier around strategy and knowing where to go, a lot of buyers sit there and say, here is my universe of wish list of potential acquisition targets. I know my competitors or adjacencies or areas of growth, whatever that happens to be, product, geography, the like. They're tracking them. They're getting to know their management teams. They're meeting them at events and the like. And there's always, some of the great deals come from, we started talking 2 years ago at a conference, and then we had another conversation a year later, and all of a sudden now we decided it was the right time to do something, and you get that proprietary deal that didn't go through a big auction process. And so it's about staying close to those companies that are on your target list and building the relationship with them, because I think in particular in corporates, they're, not to say price doesn't matter, because price matters a lot, but so does culture, so does people, so do those relationships a little bit more than the private equity transactions.
Emily, anything to add there? Mark?
Yeah, so one of the most successful corporate acquirers that we work with, he took that sort of second approach, that it was his job, and basically all the companies that he was potentially interested in acquiring were sort of his sales pipeline. And so it was very much about his personal relationship, which he had built over decades with those individuals, and following individuals from one company to another and knowing them on a personal basis. I would say if you're a very large corporate and you have an M&A team, then that second activity where somebody has the time and the bandwidth to go out and get to know everybody in their industry who is senior management and above, who's going to rise, and you'll get those sort of proprietary deals. But not every corporate acquirer can do that, in which case I think John's first approach, which is, well, at least know the people who know the people, right? And get out and know your investment bankers who will spend their time getting to know all the potential targets sort of on your behalf, almost like an outsourcing of that sort of individualized approach of a sort of corporate acquirer.
Mark, anything to add there?
Yeah, real quick, I agree with everything John and Emily said, and I would repeat a kind of truism that we talk to companies about on the sell side, which is, especially in the technology space, the companies tend to be bought, not sold, right? And so it's not because a company decides now it's time to sell, I'm going to hire a banker, I'm going to go to market. Those deals certainly get done, but the majority of deals we see are some buyers been carefully tracking them, right? They've gotten to know them, they know the market, and they've reached out, and they would prefer to acquire the company, outside of a formal auction process, right? Where there's no competitive activity, right? So just being aware that's a lot of deals are being done on that basis. So, it's hard if you don't have a full function to go scour the market, right? You can try to leverage bankers and other investment professionals for that. But that's kind of the basis on which a lot of deals get done.
Awesome, thank you. I'm going to open this one up to the group. I'm not sure if this is going to nail it on the head, but their question here is, do you think a buyer prefers to deal with a public company than a private company?
Oh, I'm happy to jump in there.
Yeah.
I think it really depends on what you're doing. I mean, I think a public company is generally harder. Well, it's harder in the sense that everything you do is going to be scrutinized, right? It's probably big enough that you're going to have to go through regulatory clearance. At the bare minimum, you're going to be dealing with SEC issues, right? And so every public deal draws lawsuits. Every deal, it doesn't matter how good your process is, how squeaky clean every element of it is, you will get sued. And that's fine. That's the cost of doing business. But there's a lot more potential for, scrutiny of kind of how the deal is being put together. In the private company context, you don't have to worry about any of that. On the flip side, from the deal terms perspective, public deals can be a little bit easier, right? Because you don't have to wait to get an NDA in place. The public company's got a whole bunch of information on Edgar. You can get really smart without the company ever knowing you're interested in doing a deal with them. And you don't have any of the indemnity kind of discussions, right? It is what it is. You buy the company, and if it's got warts, that's your problem, right? There's no recourse. You can get rep and warranty insurance, but from Emily and her team, of course. You don't. That takes public deals in a way, even if they're $100 billion deals. In some ways, are easier to get done, which is why you see them get done over a weekend sometimes, because there just aren't that many toggles to worry about.
Emily, kicking it over to you. What do you see?
It's a really interesting question, and I think Mark's right. The scrutiny aspect of anything involving a public company makes it a potentially painful process. And I think, but as a result, I'd have said a private company is probably easier to deal with because you don't have that sort of everybody watching what you're doing, and he's 100% right. You will get sued.
John, your eyebrows hit the ceiling when I asked this question.
It's more, I think about it most, I think Mark said it well. It really is that balance there. I think the point that I would add is it is a balance. And if I guess the way I would think about it is when you're interacting with a public company, they're more often than not to have a more robust corporate finance or corporate development, M&A finance, M&A functions, because it's part of what public companies do. And private companies more rarely have that, except for the largest ones. And there tends to be more emotion in private companies, especially when you're dealing with founder-led businesses, which can be a blessing and a curse, depending upon where that relationship comes back with. So outside of the regulatory matters at all, just the process, the cogs of doing a transaction tends to be easier with public companies because they know what they're doing. Private companies, it's sometimes a gamble.
Almost at time, but I still want to get to some of these questions. Let's see. So this company's individual is in life sciences, and so any advice around what your predictions for M&A in terms of securing M&A for life sciences? And it's okay if we can pass that question. It's very specific.
Yeah, I guess so a few quick thoughts. One, my perception is that the IPO market for life sciences companies is less chilled, which is helpful to the point about, is there any kind of competitive tension in the system? I think if it's a full exit, hard to say. I mean, one of the nice things about life sciences companies is you've got more strategic options available to you, right? A full-on sale is only one way to get out, right? Some sort of licensing deal, exclusive licensing deal for all or part of the things in your portfolio is always an option that, non-life sciences companies don't employ as much. So, I think you've got that in your back pocket. And the other thing I mentioned is, it's M&A, but it's not a full exit. Seeing more companies in the life sciences space saying, well, we've got complementary portfolios of drugs. What if we just combine with the hope that we're an easier fundraising choice for venture capital firms, because it's sort of like diversifying of the mutual funds when you've got a broader range of drugs that could prove to be successful.
Great. Another question here. Do M&A experts like you and your buyers, I'm guessing, also look at technical company due diligence?
Yeah, so maybe I'll just start here. When we think about the range of due diligence, it is very wide. You really, buyers do due diligence in every functional area of the business. So, I came up through a financial diligence. We're an accounting firm. We do a lot of financial and tax diligence, but we've got teams, and I would say the majority of the times we're deploying teams that do technology due diligence. So what is the IT infrastructure environment there? The product, I do tech. So we think about products. So what is the platforms, the scalability, the usability of the product in terms of light of the consumer? You're doing things around HR, you're doing obviously legal due diligence, a lot of insurance, facilities, the list goes on and on and on. As you kind of think through a functional P&L or departments of your business, there are diligence teams for every single one of those functions that get done.
Helpful. Anything to add, Emily, Mark?
Yeah, I mean, we would obviously on a rep and warranty, if you think about every single rep, if there's a technical rep, then we would expect to see technical diligence, right? Like, you're not allowed to take anybody's word for it.
And the only thing I'd toss on top of that is that diligence, I think, generally should be driven by what the sources of value are, right? Obviously on the legal side, part of what we're looking for is liabilities, where it's not about the value of the company, but making sure they didn't screw something up so bad that there's got some undisclosed liability that will emerge post-closing. But what's interesting is, a lot of deals are done on the basis that, and this isn't to the technical point, right? But I think it links up to it. If the technical piece is critical, yeah, of course, you want to do diligence on that. In the same way that what is interesting though, when it comes to people, right? This deal really hinges on these people. I'm surprised with the infrequency with which a buyer will go through and do a background check, right? Like a deep background check, which is interesting, and the times we've done it, you find some interesting stuff, right? Are there any instances in their past where it looks like there was any kind of dishonesty or anything like that, right? Because you're putting a lot of trust in folks. So anyway, a general principle that, whatever makes this an attractive asset, right? That's where I'd spend my diligence, time and money.
Oh, that's great. Great advice. And then to round us out, and I'm not sure how much experience all of you have in this one, but any guidance for additional diligence required in Eastern Europe?
All I would say is that they're going to expect you to have local counsel. So you're better off with a big firm for international transactions. You're going to have local counsel in those areas so that they can communicate very effectively with your US based counsel, like Wilson or KPMG.
I think in addition to that, you've got tax issues in every country, and Eastern European. I mean, every country has a different tax regime. It's very different. So I think tax becomes very localized. You're going to want tax providers or tax diligence advice in all of those countries that you're looking at. And the second big area that I see change is people, right? I mean, you start talking about Europe, you start talking about in some countries with work councils, certain pension plans, just depends upon where you are. That becomes a very localized, very kind of gotcha area.
Mark?
Yeah, the stuff that kind of immediately pings for me is one, like export control, right? To the extent anything's leaving the country, where's it going? Because a lot of countries a little bit further east where sanctions might be relevant. And the other thing too is just really understanding kind of what ties with Russia there are. For a number of regulatory reasons, anything Russia related immediately sets everyone's hair on fire. And so just kind of understanding, is this actually our development center, sitting in Croatia, sitting in Ukraine, sitting in somewhere else, right? Or is it someone operating in Russia, in this country, because it's, you know, an easier way to do business given the scrutiny that's on Russia. So that's the immediate concern for us.
Amazing. Well, we are almost at time. So thank you, Emily, John, and Mark for joining us today and sharing your expertise. I'm looking forward to welcoming you back in 6 months and hopefully being still able to get a hold of you despite you being more busy and cautiously optimistic in this moment.
Sounds
Thank
great.
Likewise. Thank
Yeah.
you.
Thank you so much.
Amazing. Well, for those of you still on, thank you all for joining us for this boot camp. If you're interested in a follow-up meeting from our partners in panel 2, just raise your hand in this final poll and we will make sure to connect you with John and Emily and Mark. But we really appreciate you for joining us, and from all of us at the Nasdaq Entrepreneurial Center, thank you again for joining us. Hopefully this is helpful, and we look forward to welcoming you all back online soon. Have a good one, everyone.